have a great speaker to talk about one of the very important fundamental things about if you're considering doing a startup is the structure of how you form your entity. And today we have Jason Putnam Gordon from Porcellini, and he has done a lot of, he has helped a lot of startup to form their, to do their company formation. And Jason actually, I think he's been around in the Silicon Valley for a long time. So what I noticed is working with startups all over the world. I mean, especially foreign startups. I mean, they don't really understand sometimes not to conduct business and raise funding in the U.S. You must have a entity in the U.S. for the U.S. investor to be comfortable to put money into your company. And previously, I think Jason also worked at Wilson Sonsini, one of the top law firms in Silicon Valley. And today, he'll go over a lot of the, I think must have knowledge. For me, I've been coaching, mentoring, advising many startups, and still surprised. But again, now for the first time entrepreneur, I mean, there's so many things that you have to learn about when you do start your own company. But this is, I would say, is one of the fundamental things, because if you don't structure your company correctly day one, there will be severe consequences that you might face later on. So without further ado, I'd like to introduce Jason Gordon as our speaker for today. Jason, please take it over.
Thank you very much, Joseph. I appreciate the invitation to be here today. I want to thank the Special Interest Group of IEEE. Today's talk, we're going to discuss starting your new venture, how to start your new venture correctly, how to get the right entity formation together in order to be venture backed. When we talk about that, we're going to be talking about entities that are going to pursue venture capital financing. So that's a very special kind of beast that deals with a company that's going to require a large amount of capital to grow and scale. That's part of its business plan, and we'll talk a little bit more about that today. We're not going to focus on startups in the sense of just new businesses. We're going to be talking about businesses that are interested in that will require a vast amount of capital to grow and scale. So without further ado, I think we should move into today's discussion. First thing I always like to do when I begin one of these presentations is just to give you a gentle reminder that today we're going to be talking about general information. It's not going to be legal advice specific to your situation. That's true even if you ask me a question and I give you my off-the-cuff response. Frequently, we find that in this particular area, just a couple facts here or there, something that even the entrepreneur may not be aware of as being important, actually turns the outcome or the advice that we would give. And the reason for that is that, as with many things in law and also life, there are rules, there are exceptions to the exceptions. And so, in even a brief conversation or discussion that we have today, I'm not going to be able to obtain all that information in order to give you good advice. So that's another way of saying the corollary is make sure you retain competent legal counsel to review all the facts and circumstances to the extent you're looking for legal advice. Let's see. So let's start today. I want to give you a little roadmap of what we'll be doing. First, I'm going to talk about my background. Joseph's already given you a little bit of a preview of that. Then I want to learn a little bit about you. Hopefully you all know how to use the raise hand function on Zoom here. Then I want to have this really be an engaged discussion today about intro to entity formation, what you should be thinking of from the beginning of when you're starting your new project. So what I'd like to do is talk about the big picture considerations, talk about structural considerations, give you some information to give you some foundational basics, some working knowledge that you're going to need to have. We got a special request for some information on environmental social governance companies today. That's a hot topic. It's only becoming hotter. We'll talk about that a little bit. And then to the extent we've got time, we'll move into common mistakes and then do a Q&A session if we haven't answered your questions. For the questions, if you have them, please use the Q&A function. I'll try to respond to them in real time. What I'd like to do is try and make this a bit of a dialogue. So again, use the Q&A, don't use the chat function. That helps. I'll be able to kind of control things a little bit better and follow along. And, if I see like we're getting stuck on something, we might have to come back and address that question at the end. So with that in mind, let me tell you a little bit about my background. So I'm a venture capital and emerging growth company attorney. I'm with Polsinelli LLP here in California. We've got throughout the US, 900 attorneys, roughly 900 attorneys in 20 and 25 offices. We're domestic focused, but we work with a lot of international startups. Those are companies that are coming here to the United States to take advantage of our market in terms of customers, or take advantage in terms of our financing market and the venture capitalists who are here and the sources of capital. So my office is in San Francisco, California, but I work with companies all throughout the world. I love working with early stage companies. I have a little bit of the startup bug myself. Before I came to Polsinelli, which is a large firm, and after I left Wilson, which Joseph mentioned before, I started my own law firm focused on venture-backed companies, and I ran that for about 5 or 6 years and grew that and really enjoyed it. But it's nice to be back at a big shop because we've got access to lots of different technical experts, which is critical in this area, and then also geographical spread, which is fantastic. So with that in mind, I'd like to see if we can get folks to use the raise their hands and sort of declare who's in a startup. And I'll just keep a look at the attendee list to see if that's working out. Okay, so we got at least 1 person, 2 people, 4. Okay. And the purpose of this is not to slow down the presentation, but so I can get a sense for who's in the room and kind of tailor my comments to who's here and what we think might be interesting and helpful for folks. All right, so I'd say probably about half the folks here. Corollary is who's a founder, or a related question really is who's a founder. Fantastic, probably about 1/4 of the folks. I'd like to know, who are those first-time entrepreneurs in the room? Great, don't be shy. First time is amazing experience. I also say that entrepreneurship is really a skill. It's not just a single skill. It is a blend of many, many skills and a network. And so if this isn't your first time, if you've previously had a startup and you've had a successful exit, raise your hand. All right, and if you have had a previous startup but not had a successful exit, please raise your hand as well. Now, usually I get a chance when we do these events in live and in person to comment on just how much, and have those folks who just raise their hand talk about how much they learned their first time and maybe sometimes even their second. So who here is interested in entity formation today? Awesome. All right, I'm seeing all these hands going up. You've come to the right place. We're going to dive in. I'm going to try and keep it, I'm going to try and give you the big picture items, zoom in a little bit, but not overwhelm you. Again, if you've got questions, I'm happy to take them as we move through the material. Just please use the Q&A function. It's a little hard sometimes doing these online presentations. So again, the more engaging we get, the better we can make this, and the more fun it'll be. So big picture here is that startups, venture-backed companies require substantial amounts of capital to grow and scale. Okay, we're not talking about hundreds of thousands of dollars. We're talking about millions of dollars. We're talking about tens of millions of dollars. So, and this happens over a relatively short period of time, for among other reasons, that is what the time horizon of what the capital is, that is what the investors are putting in. So everything sort of gets compressed into about 7 or 10 years of real intensity. Now, it might take a couple of years before you get that first venture investment, but you're kind of looking at kind of 10-year lifespan, plus or minus 3, at least until you get to a liquidity event, or the option, or at least to either an option, liquidity event, or maturity. Liquidity event being an M&A exit or an IPO. Maturity meaning, your company is like stabilized and leveled off in terms of revenue. Now, the goal here is really just to tie all these inputs and put them into the company so you make that grow. So you see, the sort of various things, or various buckets at a high level, include capital from the investors, intangible assets. Those are the ideas and other folks, other things, other IP by the founders. And then you've got those technicians, those folks who are going to execute on that and deliver value. And so you're going to want to tie each of those inputs into the company to make it grow and increase in value. And as you do that, it doesn't just happen overnight, right? So what happens in a typical financing startup life cycle is that, very early stage, there's so many companies that don't make it, okay? They don't make it for a whole host of reasons that are within or even beyond their control. Some of the things that come to mind include right idea, wrong time, wrong idea, even though it is the right time. You've got founder issues. You've got either because they don't agree or they don't have access to a network. Again, exogenous factors like macroeconomic things. The pandemic has, for many startups, wreaked havoc on their business, either because it affects their business directly or it has affected the startup funding ecosystem. And we could talk a little bit about that a little bit later if you're interested. But you'll see what happens is very early stage, before you even get to that first, second, or third, which are the venture financings, there's going to be initial seed capital. And that initial seed capital is the initial capital to build out sort of prototypes, to also put that initial team together. And that space is usually kind of occupied by angels, triple F, which we refer to as tongue in cheek as friends, family, and fools. And this is also where a lot of the accelerators play these days. And there's a tremendous sort of mortality rate of those very, very early stage companies as they get what some call de-risked. De-risking is really about doing the shakeout, making sure all the founders and the team fit together. They've got an idea that works in a market that is gonna explode or gonna support it. And then right as they start to scale. And as you move from that is early stage companies to those mid or what's called growth stage companies, that's as you kind of move from the A to B to C until finally you've hit somewhat of maturity. You're getting ready for either a pretty large M&A exit or an IPO. So with those big picture items in mind, let's talk about some of the foundational basics that probably very nuts and bolts, what you're interested in getting out of today's conversation. Okay, you probably want to know what the right entity form is. You probably want to understand, or certainly once we talk about what is typically the right entity form, what's the form of ownership for that to avoid a really pretty common pitfall, which we'll talk about. And then what does that mean in terms of ownership, who owns what? And then let's talk about the big D that folks frequently are pretty afraid of, and that's dilution. And let's talk about how that works, especially as that sort of works with regard to this this life cycle, which we're talking about, where the goal is to take it, the goal is to scale. To scale, you need to have other injections of capital because you're not just putting the revenue back into the company to go, but you need to get additional capital in, what that means. And in the result of that, the natural result of that is dilution. And dilution, as we'll talk about later, is part of the game. It is part of the game in the sense that you're trying to grow the entire pie. So while each person's individual slice might become a little bit narrower, you're still getting more pie overall. All right. Now, I'm going to caveat this quite a lot by saying, this is usually, I'm going to just not bury the lead here. Usually the right form of entity, if you're going to be a venture-backed company and you're going to raise capital here in the US, is a Delaware C Corp. And we'll talk about that in a moment. Now, I say usually because that is probably 90 or more percent of the time the right answer. We do sometimes do LLCs or work with LLCs, and there are some particular considerations that might swing it one way or another, but that's usually where you end up. And the reason for that is that, we go through the same analysis that, and I always do this regardless of if it's going to be a venture-backed company or not. We start out, and I say that I always do this because many times individuals will come to me and they'll say, or entrepreneurs will come to me and they'll say, look, I've got a great business idea. I want to form a startup. I want to raise venture capital. And then we talk about what their capital needs are. And they'll say something along the lines, well, I think we're only going to need to raise $1 million. And $1 million is a lot of money, but that is not the space in which the VCs play. And if that's not part of your business plan, then a venture capital model is not the right answer for you. So every time an entrepreneur comes to talk to me about any formation, we always go through the same kind of matrix. Okay. We take a look at about 6 things. We take a look at liability concerns. What is the liability exposure for the founders, given the various entity structures. We talk about tax, whether or not tax is going to drive the decision in this matter. We talk about what kind of management structure they're going to need to grow and scale the company. And what I mean by that is who's going to have decisional control and how does that relate over time, right? Usually at the beginning, the founders, the entrepreneurs have complete and utter control of the company. But as you raise outside capital, you will find that those folks who are putting in money will frequently want a seat at the table at some or all of the decisions. We talk about your capital raising requirements. We talk about that in 2 contexts, really. I mean, we talk about that in terms of what I just mentioned, which is how much you need to raise, but also in what form. What is the structure? What are those investors going to want to see? And then we talk about, and I'll unpack that a little bit in a moment. We talk about whether or not you are going to need to or want to issue equity to employees or to contractors, which we would call, equity incentive. And then we talk about the contemplated exit. Now, going back to the frame or the sort of idea of not burying the lead here, what inevitably drives the decision for a company that requires a lot of capital to scale, they've got the right time horizon for a venture capital investment, that sort of 7-10 years, kind of plus or minus 2 or 3, is a C Corp. And the reason for that is a tax reason. The reason why it's a C Corp is because those funds they're set up in a pass-through entity. That is, to the extent there are profits or losses, those profits and losses get passed through to their partners. So they need to have what we call in the biz a corporate blocker in place. That is a C Corp, so that those losses aren't getting passed on directly to their investors unless and until there's some sort of exit. Now, why Delaware? So there are plenty of great California corporations and even some venture-backed corporations that are Delaware. We sort of typically see this because of a few things. Delaware is known for having a particularly sophisticated corporate law. And what that means is Delaware has been focused to bringing businesses to its jurisdiction, at least I think since the 1920s. So they really do spend a lot of time and effort to make sure that they make themselves business and corporate friendly. They have the Delaware Chancery, which is a court that is dedicated to resolving business and legal issues. And as a result of that, they've got very developed case law. Now, for non-lawyers, that probably doesn't make any sense when I talk about it. But for lawyers, what we think about is if you've got developed case law, that means usually if your company is facing a problem, someone else has faced it in Delaware and litigated it. So you have a sense for how that issue would be resolved under the law, which hopefully results in more certainty as to what it is that you want to do, which means, of course, spending less time, ultimately less time and money on lawyers arguing and in litigation. And then one of the sort of more mundane reasons, but is very important for us practitioners, is that the Delaware Secretary of State's office runs a very efficient shop in terms of processing paperwork. And that is really critical when you're trying to get financings closed or you're trying to do a merger or an acquisition, and you need to get paperwork filed and processed quickly and not bounced because the state employee isn't really thinks they're familiar with the law and is mistaken. Now, I'm going to pause there to see if we've got any questions outstanding. Let's see. Nope, not yet. Well, hopefully I'm not boring, folks. What I want to do is unpack for you the actual formation process, which involves, for a Delaware corporation, or for many corporations, really, you can borrow that. There are a few things that have to happen. What actually forms the corporation or gets the ball rolling is filing a certificate of incorporation with the Secretary of State. So there's a person who's called the incorporator, and they put together with the attorney a certificate of incorporation. It sets out some basic stuff. It sets out the name of the company. It sets out how long the company is going to last. It will provide the information on the initial agent for service of process. That's the person who gets contacted or sent the service of process. That is basically the complaint or some other legal filings. Should the company get sued, what the registered address is in the state, how many shares of stock are authorized. And I'm going to just kind of put a little pin right there to see, to say we're going to come back to the number of shares that are authorized, because that's a critical concept that I want to make sure folks understand at the end of this conversation. And that's kind of basically, we talk sometimes about indemnification and appointment of directors and stuff, but that's kind of it in a nutshell. Gets filed. Then the corporation is formed. The formation is not complete, but the state will now recognize that there is a corporation out there. So to kind of finish out the incorporation, you want the incorporator to resign, but first appointing the initial board of directors. And that board of directors will take the initial steps of approving the things that the incorporator did, appointing the officers, and also setting the stage for issuing the initial shares of stock. So with that in mind, what I want to do is kind of talk to you about who the various participants are in the corporation, understanding that for each one of these bullet points, I consider that to be a different hat, and an individual may wear more than one hat. So stockholders are the owners of the corporation. They own shares of stock. And to just take it up a notch to my all caps point about ownership being embodied in shares of stock, not percentages. When you own stock, like when you own stock in a company, that is what represents your ownership interest. It's not a percentage. So when we're talking about a percentage, what we're doing is we're taking the number of shares of stock you have and putting that over a denominator, either all of the authorized shares, all of the authorized and issued shares, or sometimes some fully diluted basis, which basically says, even though this stock hasn't been issued yet, somebody else has some sort of contractual or other claim over it. So stockholders are the owners. They got the right to elect the directors and to get dividends. When you're in an early stage company, there aren't going to be any dividends. So aside from ownership, your primary report or drive is electing the directors. Now you can think about the board of directors as sort of being like the brain of the company, if we kind of think about a person. I say that because it is the job of the directors to make the policy of the company and set its sort of long-term and also short-term direction. Now, once they set that, it's the officers whose job it is to carry out that direction. Now, the directors set that out either in their board meetings, which are memorialized in minutes, or in written consents. And then the officers, you've got, the CEO, CFO, secretary. Sometimes the CEO role is interchangeable with the president, sort of depends on your bylaws. Sometimes the CFO role is interchangeable with the treasurer, again, sort of dependent on your bylaws. But those are the folks who have fiduciary duties to carry out the direction of the directors. Now, the CEO can and is usually an employee, but employees don't have to be officers, right? I mean, you could be, a part-time temporary employee just working on the assembly line or getting coffee for somebody else. That's another role. Consultants or contractors are another group of folks who are usually, and sort of more technically, not at the direction of the company, but are retained for special expertise, for their particular expertise or a special project. We've got a question about how binding LOIs can be around conditions of incorporation, commitment of IP. So I will take that question towards the end because I want to keep it focused on what's on the slides right now, but we can talk about LOIs a little bit later. Let me move back here real quick, make sure I didn't miss any notes. Right, so certificate of incorporation gets filed by the incorporator. The incorporator appoints the directors. They do the board meeting. There's issuance of stock, appointment of the officers, and you're pretty much off to the races at that point. There are sometimes some other things you need to do in terms of registering in your city or county, qualifying. You know, if you're here in California, but you create a Delaware corporation, you're going to need to qualify as a foreign corporation doing business here. But by and large, we talked about the real nuts and bolts there. Now, great. You've got yourself a corporation that is up and running. You got to tie out and tie in all of those inputs, which we talked about earlier, right? So it's making sure that all of the IP that is being generated moves into the company. And that's all IP that is related to the business, right? If you got some IP that's not related, we're not necessarily concerned about it, but certainly anything that's going to be required for the business to execute on its business plan is going to be necessary to get in there. Vesting. So one of the real main concepts here is that, and this is what funds and other folks in the space are going to look for, is making sure that everybody's interest is aligned appropriately or within what we would consider to be norms. In other words, market. And what that means basically is that we don't want to have a situation where there is one founder or more than one founder and they leave. They leave early, they leave before the company is successful, and they take a large amount of the company with them. So to mitigate against that particular issue, we have this concept called vesting. Now, vesting gets put in place by agreement. When I frequently talk to entrepreneurs, or frequently when I talk to entrepreneurs about vesting, they sort of think about somebody's stock vesting as points in time go by, we give you these number of shares of stock. And from the IRS's perspective, that's true, and we'll talk about that in a moment. But from the legal perspective, it's a little bit different. What I like to do in terms of making an analogy is thinking about when you get your, so when there's that initial board meeting or board consent, and we're distributing the initial shares of stock, they're going to be subject to stock repurchase or restricted stock purchase agreements. So there will be this vesting tied in there. What the founders will do is they will buy their stock subject to vesting. That is, they will pay for all their stock, which is not very expensive because the company is just starting and doesn't have much value. And they will get all of their stock. They'll get all their stock. Now, that stock is going to have strings attached to it. And so as time goes by, strings will be cut. And that is how they end up kind of having their stock. If they walk away with the stock that has had its strings cut. Now, there are probably, just to put a finer point on vesting, there is both single and double trigger vesting. Single trigger means a single and double trigger acceleration. That means basically if a specific event happens, that person, all the strings get cut at once. Much more common is double trigger acceleration, which usually is triggered if there's a sale of the company and the founder gets terminated within a certain time window, as opposed to just the sale of the company. Now, why this is important is sort of twofold. Of primary importance, I already mentioned. That is, you don't want someone to walk away with a large chunk of company of the company. And I will tell you that it is very frequent that I will have a client or a potential client come, and or a new client to me, and one of their founders or an early employee will have exited, and the remaining founder or team feels like the other person walked away with too much capital, even if they had vesting agreements in place. That is, so much time went by, they vested a lot. They didn't resubject any of those shares of stock. And there are some things that can be done, but it's sort of difficult to move the needle on it, and it opens up the company for a lot of litigation, and the remaining founders to being subject to a lot of litigation and potential personal liability. So it's pretty hard to get right. excuse me, it's pretty hard to deal with after the fact. Now, the other reason is, again, the investors won't, sophisticated investors will not put money into your company if there's not enough skin in the game of the founders. That is, they're not subject to vesting. So if you've not subjected your shares of stock to vesting, or enough time has passed that almost all or all of your shares of stock are no longer subject to vesting, they're all vested, you may have to resubject some or all of your shares to vesting via stock restriction agreement. So one sort of fine point is get that in place. It also helps to make a sort of psychological anchor if and when you're going to be raising that, you've already done this and you should be entitled to what the company set you up with originally. That's usually a stronger negotiating position. Not always if you're basically already almost all vested, but if you're kind of on the margin, you may have a little bit more stock. Now, a moment ago, I talked about how sort of the IRS does view vesting as if you're getting those shares of stock over time. And as a consequence of that, even though the founders may have paid very, very little for that stock, and they may have voting rights and some other rights that are associated with having that stock, if they're subject to the repurchase by the company, then it's only once those strings are cut that you are deemed to have had them for tax purposes. So what can happen is that you can have, you can buy the stock for, let's say, a tenth of a penny, but that string doesn't get cut until that stock is worth $1. And so you're going to have tax due on the difference between that dollar and a penny. And if you've got 1 million shares, you've basically got $1 million worth of income, and you got to pay taxes on it, and you don't have the cash for it. So to address that issue, the IRS under Section 83 has what we call a Section 83B election. That's a piece of paperwork that you can file with the IRS, effectively prepaying any tax that is owed on that stock. You need to file it within 30 days of when you get your stock issued. There's like almost no way to fix it if you miss this, if you mess this up. So it's a big deal. But what that does is then that makes it as if you received all your stock at the time that you've issued it. You don't have this tax issue, which I just mentioned. The sort of downside is if for whatever reason you do prepay a bunch of tax because of that, you will, like, let's say the stock was worth $1 a share and you got it for little or nothing, so you paid ordinary income tax on it. You won't get that tax back if you leave early and you lose some of that stock. Now, we've talked about vesting. Let's talk a little bit about transfer restrictions, because what we're doing basically is talking about those inputs again. We're talking about making sure all the IP is tied into the company, and we're making sure that all of the ownership and capital is tied into the company. So one of the things that is important for investors and for a company is to also control, to a certain extent, who is on its cap table. And we may say, well, why is that? Well, there are a couple of reasons for it. One reason is that under the 34 Act, if you've got more than 500 unaccredited investors in, or 2,000 investors, depending upon how you count people, you may be required to go public early. Okay, that is an immensely expensive event. If you're an earlier stage company, you may not be ready for it. And so that's a real problem. Another issue is you don't necessarily want a competitor to have your shares. Another issue is that people can pay, because the owners of the shares of stock have the right to elect the directors, they ultimately kind of have the right to control the company, not super directly, but indirectly. So at the outset, we will see transfer restrictions either in the restricted stock purchase agreement, which I mentioned, sometimes in share purchase agreements, shareholder agreements among the founders. That's kind of more of a Midwest East Coast thing. I've noticed out here, it's a little bit different. And then the other place where it typically tends to show up is in the bylaws and other governing documents as sort of like a catch-all. So that is kind of it in a nutshell in terms of the initial documentation. The other thing that you'll see is you'll see offer letters for the founders sometimes, and a proprietary information and invention assignment agreement. Basically, the way it happens is this: any IP that gets developed kind of prior to the issuance of stock gets put into the company as of the issuance of stock, and then any IP that gets developed later gets put in the company via the proprietary information and invention assignment agreement, which does IP assignments, and then also puts in place confidential obligations of the founders and other early employees. All right, we've got a question about ISOs versus non-quals. We'll talk about them at the end. Pros and cons of entrepreneurs registering their companies. I'm not, I think that that's getting at if you decide to incorporate versus not incorporate. So I'm going to take that question and spin it that way. If I'm wrong, just re-ask it a little bit differently. Let me start by not burying the lead. My rule of thumb on this issue is if you've got more than one founder and you're kind of past, or you're starting to write things on the whiteboard, you should at the very least be thinking about incorporating. The reason for that is that if you are starting to generate IP or you start working on a business and you don't have some sort of entity, then you probably have what we call a de facto partnership, which is a business form that has unlimited liability for each of the participants, and the others can bind them to it. Plus, if you do not have the IP directly assigned into the entity, there is a lack of clarity over who owns that IP. You may say, well, why do we care? Or maybe we'll just call it joint IP. Depending upon the kind of IP, that is intellectual property, and there are basically 4 buckets: copyrights, patents, trademarks, and trade secrets. There are sometimes duties to account for one another. There's duties to pay one another on some of them, but not the other. And it's kind of it's just basically a real nightmare. Now, what does that matter in terms of nightmare? Well, if you've got an entity or you've got a business that you're looking to raise investment in, no one wants to invest in a lawsuit, right? At least not in the venture capital space, at least not when it comes to them really being focused on having a new product or technology out there. So rule of thumb is if you're taking your idea onto or basically coming off of a whiteboard with more than one person, time to think about incorporating. Now, if you're a single founder and you've got an idea on a whiteboard, you may be able to wait a little bit, but again, because you don't have that risk about someone else coming in or leaving and taking some rights to the IP and having a lack of clarity over that. But you still have potentially some tax issues in terms of if you wait too long before you put that IP into the company and you've got other investors who are coming in on the same time, it may be a taxable event. So it can be a problem that you'll have to deal with. And by a taxable event, I mean, if you get $1 million worth of stock, but you don't have $1 million in cash to pay for it, you have to pay something less. You may have to pay cash. You may need to pay the taxes on that, and that's a real problem. Let's see. Hopefully that answered your question. All right. Foundational basics. Who gets what? Well, there's not really a set answer for this. The way I like, so lots of new companies will sort of, especially like if they're co-founders or 3 founders who have known each other socially or through school, will want to split everything equal. And that's not wrong. But I think probably the better way to think about it is for each of the founders to really sit down and think about what it is that they're bringing to the table in terms of technical expertise, network for raising capital, and or a network for bringing in other talent, and sort of trying to put their relative positions, have those and make them in terms of percentage ownership, which of course we convert into shares of stock because everybody owns shares of stock in a company. They don't own a percentage. Now, I think that's probably the best way to do it. There's some other resources out there, including Idea to IPO and IEEE, and you can avail yourselves of those. I want to talk a little bit about valuation and talk about, I got a flash here. Hold on one second. Just want to see if I'm missing anything. Oh, Q&A. All right, I don't know what happened there. Okay, super duper. So let's talk about valuation in the big D, and because that's something that is very important. So if you go back to maybe the second or third slide, we had the life cycle stages, and there were injections of capital along the way. There's the seed, then the Series A, round one, which is Series A, B, C, et cetera. And in those periods of time, new money is coming in and additional stock is being issued. So what I want to do is I want to talk about these concepts briefly. So briefly, we hear the term pre-money valuation bandied about. That is the value of the company before the next round of investment, before those dollars come in. And post-money is the value of the company before those dollars come in, plus the value of the dollars that come in. So I want to take you through a simple example, but I've got a couple of just points or things to bear in mind. One is usually when we're talking about this, it's with regard to a venture round. And even though we're using pre-money valuation, we're really thinking about that in terms of, what is it the investors are willing to pay? Now, more specifically, it's more art than science when it comes to that. And just because you could get one investor to pay one amount doesn't mean you'll get another investor to pay that. So in one sense, it is the value of the company because that's what somebody is willing to pay for a percentage of your company. But in another sense, these things can vary a little bit as they come to other valuations, including 409A valuations, which we can get to a little bit later. So just taking a simple example here and not taking into account an option pool or any other equity, which might be out there, including convertible notes and safes and all kinds of stuff like that. If we had a company that had a pre-money valuation of $10 million and that company had 10 million shares split among all three of its founders, then we'll take the case of founder A. Founder A would have 3,333,333 shares of stock, or 33.33% of the company. Now, if the new money coming in is going to be $3 million, because there were 10 million shares outstanding and the pre-money valuation was 10 million, the value of the company on a per share basis is $1. So when those $3 million come in, the venture capitalists get 3 million shares. The post money is now 13 million, and the issued and outstanding stock is also 13 million. So founder A went from having 33% of the company to 25% of the company, but founder A's shares are now considered worth, 3,333,000. So let's take it for the next round because this is important. Pre-money is now 30 million. So what happened? They got that $3 million in, and then they got their product out the market, or maybe it was already up to market. And so they were able to use that $3 million and they were able to put that into marketing, and they scaled it. And all of a sudden they started generating a lot of revenue. And this took some time, took 18 months, let's just say. And it caught the eye of some other investors who were super excited to put money into this company. And they come in and they say, oh man, I want to have a chunkier company. I'll value it at $30 million. So again, there's still only 13 million shares outstanding. I'll value at $30 million, and I want to put in $10 million. So you got the pre-money valuation is now 30 million, but there's still 13 million shares. So it's now $2.31 a share. So if you take $10 million, which is their investment, divided by $2.31, you see that the new investor is going to get roughly over 4 million. So founder A has gone from having 33% of the company to 25% of the company to 19.2, but founder A's value of his shares have gone from, when it was kind of initially formed, 0 to over 3 million to now 8 million. That's sort of how it works in a nutshell. It is super critical when you're raising seed money, when you're raising, and that is convertible notes, safes, series seed, to at least model out a few rounds and what it's going to look like based on some assumptions. And those assumptions would include sort of the pre-money valuation at those points in time in the round and the size of the round. There are folks who can help you do that. I know how to do it. I'm not the right person to have you do that because you don't want to pay a lawyer for it, but it is very important to pay attention to what your dilution is going to be over time. Excuse me for 1 second. I'm just going to take a drink. All right, so we are back on. So that, I think, takes you through a lot of the formation basics. And I want to leave some time at the back end to talk about ESG companies, to talk about some common pitfalls, maybe share with you some war stories, and then also take some more Q&A. So I think we're tracking pretty well for that. But so far, let me just recap. We've talked about formation of the company. We've talked about the initial documentation for the founders and the employees, for the initial employees. We've talked about the critical aspect of making sure that all the IP gets assigned up into the company. We've talked about the critical nature of making sure that the shares of stock vest over time so that no one walks away with a large chunk of company. We've sort of touched on some of the vesting mechanisms. We can get into some more of that a little bit later. And then we talked about the basics of valuation and dilution. So you can understand how somebody who starts out with a third of the company will eventually have a smaller percentage, even though the number of shares they have will remain the same. They may get topped up, but that's a different issue. We can talk about that later. So I think that brings us to a great place. So let's talk about ESG companies. Those are environmental, social, and governance companies, companies that are focused on that. And let's talk about socially responsible investing, also known as ESG and SRI. That area is a particularly hot area in the market. And what's going on here? Let me take you a little bit of history. Kind of prior to, I don't know, maybe 2012, this was not really on anybody's radar, or at least not with regard to the statutory law and the mechanisms out there. Sort of, there is, I guess, an understanding that corporations are focused on maximizing shareholder value. Now, if you actually look at the Delaware case law as I have, you'll actually kind of see that there is sort of a split. There are some chancellors who feel like you can take into account when you're examining whether or not directors are making the right decision on behalf of the company, you can take into account things outside of just profit or dollars to the shareholders. But then there are other chancellors who sort of take the position that really at the end of the day, you need to maximize the dollar return to the shareholders. So the purpose of environmental and social governance companies are to, I would say, tampen that dollar drive, that profitability drive, to take into account a broader set of stakeholders than just the stockholders. A broader set of stakeholders can include the customers of the company. It can include the environment in which the company, the environment. It can encompass social issues. It can encompass governance issues in terms of making sure that employees are treated correctly and certain issues are handled, without just an eye towards the dollar. And that's sort of the genesis. And so what that does is that takes the company out of just being obligated or potentially obligated to maximizing shareholder value. And this, in one sense, or I have read it, it's been credited to when Ben & Jerry were acquired by Unilever. At that point, they had to go with Unilever because it was the highest return for their shareholders. And that's not what Ben & Jerry wanted to do. But they didn't have control over that anymore. So that is what ESG companies are supposed to do. So again, the purpose here is to temper the historic measure of performance. Now, this is a little confusing because it's evolving, okay? So there's a lot of sort of the same terminology bandied about. but you sometimes hear about public benefits corporations, benefits corporation, B Corps, all these types of things. And the answer is it's going to require that you kind of look a little bit more closely. So in Delaware, these types of companies are called public benefits corporations, and you need to, you know, you need to get incorporated that way, or you need to go through the right corporate mechanisms to make it become a public benefits corporation. But you know, at that point, it's going to say that in its charter, and it's going to identify some of the things that it needs to pay attention to. It's going to need to report out periodically to its stakeholders, and that's how it is in Delaware. In California, a public benefits corporation is a nonprofit. So we don't have the sort of more analogous kind of entity out here as a benefits corporation. But that's different than being a certified B Corp. A certified B Corp is an entity that adheres to criteria set forth by B Labs, and I believe B Labs audits them and puts out a report card on them. So you could have a regular corporation that's a certified B Corp, or you could have a benefits corporation that's a B Corp. Again, that is a, you know, sort of a private label of things. Now, B Labs has been lobbying to sort of align the statutory law in terms of what benefits corporations are with its own certification process in terms of requiring an audit and these types of things, but that hasn't happened yet. Out here, we also have social purpose corporations, which are set up for a special particular kind of social purpose. And we've also got nonprofits, just as they have nonprofits everywhere. Now, that's kind of the framework of it. Let me share with you sort of my observations and some of the things that we think about when a company is thinking about becoming a benefit corporation or using one of these alternative structures. As always, I think it really goes to sort of the heart of the company and the founders, what their objectives are and what their business plan is to get there. And I say that because there are some founders who are particularly driven by dollars. And then there are some founders who are particularly driven by some sort of purpose. And then there are in all different kinds of verticals. And we find that some verticals this works better for than others. But let me say this. So with respect to that, we frequently find that if there is a founder or a set of founders who are particularly motivated by a purpose, and they are on a consumer-facing side of things, then being a benefit corporation or a certified B Corp has had, let's say, a synergistic effect on their business and business model. Because it is something that, you know, in this day and age, I think there are a lot of consumers that are focused on not only obtaining their product at a price point that they will like, but also feeling good about the company from which they are purchasing that product or service. And so those companies, if part of your ethos and part of your branding is to be a socially responsible company, or not just to be a socially responsible company, but to also have that part of your branding, it works well, it resonates with consumers. It also resonates with the investors in that particular sector. And because there are investors who are focused on either social responsibility, ESG, social responsibility and impact, that is, they have specific drives or purposes that they're trying to achieve, not just dollar returns. And then also some of these other environmental and social governance things. So if you've got that and it's kind of, it aligns well with your business, I think it makes a lot of sense. And something that should be considered. Again, we see that a lot with consumer-facing companies, whether they're consumer packaged goods, whether they are consumer electronic products, or sort of other, clothing and other types of companies like that. Now, that's kind of what we're seeing today. If you looked sort of 10 years ago, I think the discussion would be a little bit different because the discussion will go along these lines, and some of that still holds true today. By and large, investors have fiduciary obligations to maximize the return for their limited partners. Those are the people that invest their money with those funds so that the funds will turn around and invest them. the world of investors that are open to you, if you are not, if you are not, if you're interested in just making money, or that is the primary focus, is probably broader than those who are focused on some of these ESG and SRI things. So one concern you may have and that you still need to think through is, again, going back to that framework of raising capital over time, what is the business plan? What are those injections of capital? Who's it going to come from? What's important to them? I sometimes say that kind of every founder is in sales, and their first sale really is to their investors. And I say that, whether it's the seed investor or whatnot, because you're really selling part of your company. So you need to think about who's going to be interested in your company and when you're raising some money. So with that, let me just see if there's any Q&A, because if there is, please submit it via the Q&A function. And if not, we'll kind of move on to some pitfalls, and maybe I'll circle back to some items that we've talked about a little bit earlier. But I will also just mention, with regard to SRI, there's been tremendous growth over the last few years. Just between 2016 and 2018, there was a 38% growth. I was looking at a survey by PitchBook today where, I think in 2014, they sent out the survey, only 40 firms responded filling out the survey. But this year, I think 460 or something along those lines. So we're definitely tracking it. It used to be sort of 10 years ago, we'd recommend you stay away from these issues, or you'd stay away from it just because we're concerned about uncertainty in terms of raising investment. But if you're in the right space, it matches with the core mission of the company, it's a good play from both a financial perspective, and then also from, these other goals and items that you want to achieve. So let's move on to some common pitfalls, I always say. So I think I already sort of answered this one, but not forming an entity or not forming the right entity. So we talked about the pitfall of not forming an entity. You may find yourself in a de facto partnership. There might be uncertainty over who owns the IP. Sometimes those issues can get resolved. Sometimes they get resolved unfavorably, and the company or the business ends up dying. Not forming the right entity can also be an issue. So that's, or it's less of an issue in terms of if you've got all the IP and you've got all the ownership issues memorialized, it's good, we can fix it. But there could be stakeholders who object to fixing it, and they could have outside leverage, which can be a problem. Now, why is that a problem? Because again, the VCs or the other folks who are investing in your company are not investing in what you did in the past. They're about investing in what you can do tomorrow. If there's something wrong in your legal structure that's going to keep you from being able to be a successful business, that's a risk and going to lessen your chance of being able to get investment. Not getting investing agreements in place. Again, the issue is someone walks away with a large chunk of your company, and as a result of that, you're sitting there thinking that you're hustling, you're working your tail off, you're not getting any pay, while that person may have another job and make a lot of money, and you're not going to be real motivated to move forward. And it's also a problem because, again, to try and resolve some of those issues would involve issuing more stock to you, and while you may have the control to do that, there's the issue of whether or not the employee or person who exited is going to sue you over it, and you have potentially some personal liability exposure for that, right? Because one of the things as a director and officer is that you can't solely benefit yourself. You need to be working on behalf of the company and in its best interest. Not filing 83B elections. This does come up. There's and I don't want to say their name, but there was a large gaming company. The founders did not do this, and they had, and I don't know exactly how they got it resolved, but they had millions of dollars in taxes that they were going to have to pay. It's a real issue. There's not much you can do to fix it. If you miss the deadline, maybe immediately thereafter, there might be some stuff to do, but if years go by and you don't fix it, you may find that you've got a huge tax bill and no dollars to pay it. further, it's an issue that sophisticated investors are keyed into. Now, here's an issue that we did not directly address in today's conversation. Securities laws. Now, anytime you issue security, so you can think of a security as stock, safes, convertible notes, preferred stock, warrants, options, you need to make sure that you need to make sure you comply with securities laws. So usually that's making sure that there's an exemption at both the federal and state level. Because if you don't do that, one of the issues is that you, whoever purchased those shares of stock or that convertible note may have the right to resell it to the company for the money that they put in. And if you raised $100,000 on a convertible note and you don't have the money anymore, you're not going to be able to give them their money back. And so that's a real issue. Again, sophisticated investors are tied into this. They're not interested in buying into a lawsuit. So you need to make sure that you can keep that clean. That's true even if it's a small company. So theoretically, or not theoretically, I mean, even when we start and form a company, we also think about, those founders, what are their exemptions? Now, there are some pretty common exemptions for founders, so I'm not particularly worried about it, but you still need to get in that mindset. Risk of employment law issues. So the risk of, there are a few issues kind of tied up in that bucket. One is not properly classifying employees and contractors. There's a real temptation to hire, especially early on, everybody as a contractor. And I put consultants in that bucket too. Basically everybody other than an employee. The temptation is there on both sides. Okay, for the company thinks they don't necessarily need to worry about wage and hour laws. And for on the contractor side, they typically, if they're here in the US and they submit their W-9, the company doesn't withhold tax on them. Okay, there's not that withholding obligation as there would be with an employee. So there's that temptation. But the issue is, at least here in California, if somebody's working full-time or mostly full-time, they don't have another job elsewhere doing the same thing. You're maintaining control or direction of what they're doing. You're providing them with the means by which to accomplish their job, i.e. like a computer or that type of thing. They are likely probably going to be an employee. And, if they don't, and so you've got these withholding obligations, both from taxes, you've got it from disability side, as well as workers' comp. You don't do that, you're going to start to accrue some liabilities or some potential liabilities. This usually kind of comes up in the situation where that person has left. Turns out actually they weren't filing their taxes or they weren't paying all the money they should have. And then the IRS or California FTB sees them and they say, you owe us all this tax money. And the person doesn't want to pay it. So they point the finger at the company and that begets a big audit. And there's quite a lot of cleanup work. So it's usually better to try and stay ahead of this, even if someone's working part-time employee, at least making sure they get minimum wage and tracking their hours. Now, that frequently doesn't happen for founders. Folks kind of roll the dice on the issue and, it is what it is. But that kind of dovetails into a question that we have, which came in via the chat function, but it'd be great if you guys use the Q&A about advisors only working for equity. We do see that all the time. You got to make sure you got securities exemptions for them. We do see it all the time. I think the level of, it's to a certain extent about a level of risk as well. If they're an advisor and they're just really kind of putting in an hour or two there, maybe an hour a week or something like that, I don't think there's going to necessarily be the wage and hour issue that, we'd be worried about if you had some engineer who's putting in 20 hours a week. But, it's still a potential issue. Undocumented stakes in a company. This is a very common issue This gets maybe to the LOIs. How binding can LOIs be around conditions of incorporation and commitment of IP? Let me talk about that in 1 second. Let me just take a quick sip of water. So if you probably noticed one thing today, is I've got a theme, and that theme is sophisticated investors do not want to invest in a lawsuit. So having undocumented stakes in the company, if they don't discover them and you know about them, you might have committed securities fraud, which is a real problem. If they discover them because you've disclosed them or whatnot, they're going to be concerned, right? First thing they're doing is really buying a piece of your company. So in order to figure out what size piece they're supposed to get, they need to know who else has pieces. And if they're undocumented stakes, it's unclear, or it's potentially unclear who owns what. And so you may deter yourself from being able to get investment in the company. Now, how does this come up? This comes up sometimes by folks signing LOIs, from folks making napkin promises, from trading emails back and forth saying, I'm going to give you X% of my company. But one of the real issues with that, and why I always focus on articulating ownership in the form of the number of shares of stock, is that if you're talking about, and I hope you've seen this today, if you're talking about percentage of ownership, it's going to be dependent on a moment in time. Okay, it's dependent on a moment of time because you need to look at the denominator. And as you've seen, going back to our the graph of the life cycle of a company, there's injections of capital, new folks are hired, they're issued stock, they're granted options. So if you've just got a percentage out there, it's unclear what the number of shares somebody's supposed to have. And again, that can really deter investment unless you can get that documented. Again, one of the problems with that is it's easier said than done because there are frequently tax issues. And then also that person at that point in time may be able to use the uncertainty and the fact that you want a financing as leverage to extract more from the company than what they should rightly be entitled to, or certainly what you would think they were rightly entitled to. Let me just flesh out a little bit more on my response to how binding can LOIs be around conditions of incorporation, commitment, and IP. LOIs, or letters of intent, are also known as term sheets. They can be binding or non-binding. Even if they are non-binding, or they say they're non-binding, you need to read the fine print because there are frequently terms within them like confidentiality, no shop clauses, etc., that are binding. So if it doesn't say whether it's binding or unbinding, it's unclear, okay? And one of the issues is that that lack of clarity can make it difficult to resolve this issue. And the only way to resolve is to go to court. If you're a very early stage company, you've only raised even $1 million or $2 million in investment, let's just say. I mean, that's a good amount of money, maybe enough to get your product going together, your prototype and the initial team. A lawsuit is unbelievably expensive and you just don't have the funds for that. So how binding can they be? It just depends. It depends on the facts and circumstances, but the real business issue is the lack of clarity over ownership, and that can deter investment because the only way to get clarity is to go through litigation. One of the problems with going through litigation is it can be seemingly endless. Not only, do you first have to litigate it in trial court, but then there are appeals. Then there are appeals to the appeals. Sometimes it goes up, then it gets kicked back down to the trial court. It's a real problem. IP that resides in other entities. So if we take it back to the beginning of today's discussion and we talk about and we think about what's going on here, big picture, tie in the IP, the ideas, tie in the capital, all these things in the entity so that it can grow. What's going to be required is that all the IP that's necessary for the business to do its business gets tied into the entity. So how does this come up? Sometimes founders feel like they've worked on a passion project or idea on their own for a while and they want to retain it. So really what they want to do is just license the IP into the company. That can work in limited circumstances. But by and large, it kind of doesn't. That's not what investors are typically looking for. If you are a previously successful entrepreneur, you've got a track record, it's more likely for it to work, right? Because they believe in you. They've got a sense for your business acumen and your ability to take a project and make a lot of money for them. But if you're just starting off, they're going to want to see that you're wholly in on this project. They look at that as proxies. They look at that in terms of what the IP is that gets assigned in. They look at your level of commitment in terms of time. And what they're concerned about is a founder or someone else who's retaining some IP. They may not be all in, and or they may try and make money on the outside of the deal. And that's not what they're looking for. They're looking for a return on their capital. And they're afraid that if you're out there working on some other project, you're going to be sucking in, you're going to be keeping dollars that would otherwise go into the business venture that they're investing in. Now, that's one issue. Another issue that comes up in this context is if you are working at a university or another company and you've got some sort of proprietary information and assignment agreement, you may not have the rights to that IP, or you may not have all the rights that you think you have to that IP. And so it's critical to get that issue resolved. If you're working in a university, there's typically at least here in the Bay Area, a tech transfer office. There's a means by which you can license it out for a field of use, right? The idea is all the IP that the company needs. Now, the company may not need to have that IP for every single use, but certainly for a particular kind of field, so you can exclude other folks from entering. Sum it up, all the IP needs to get into the company. All the relationships with the founders need to get documented, and they need to get shares that are vesting over time. Tax issues. There are federal, state, and local taxes, and you need to make sure that you pay attention to them. You work with usually an accountant to source and deal with those issues. In terms of books and record keeping, accountants usually don't handle that, but there are some special book and record keeping services that can help you put your financial books in order. This comes up in a host of issues. We talked about how, there's withholding obligations for employees, or if you are improperly classifying somebody as a contractor, but really they're an employee. If you're selling product, then depending upon when and where you're selling it, you're going to need to not only pay the taxes on the revenue, but you're also going to need to collect taxes like sales tax and those types of issues. So you need to pay attention to those because they can really add up. There can be penalties, and it's an issue, maybe not for the super early stage companies because you don't have revenue, but it becomes an issue over time. You need to be heads up on that. All right, let me come and finally answer the question on incentive versus non-statutory shares and the difference between them. So what we're talking about now actually is incentive stock options and non-quals or non-statutory stock options. Let me go back. A stock option is not a share of stock. It is an option or the right to buy a share of stock within a certain window of time for a certain price. Now, they're usually given to employees or consultants as a means by which to incentivize them to do a good job for the company and probably also work for a slightly less pay, that is dollars, than they otherwise would work for. We see them awarded to employees, we see them awarded to officers, we see them awarded to consultants and advisors. The tax treatment on each of those is a little bit different. So if you're an employee and you've got an ISO, there's no tax that's due when you, and I'm not a tax guy, but let me just go off the cuff on this. When you're issued the option, it's not an issue. When you exercise the option, it's also not an issue. And when you sell the stock after you've exercised it, if you've held it for a long enough period of time, that's when you need to pay the tax on it. Off the top of my head, well, non-quals, you don't pay the tax when you get issued them. And non-quals can go to either employees or consultants. If you issue more than $100,000 worth of ISOs to an employee, then the rest of them are going to be non-quals. Or if you goof up any of the other sort of requirements for an ISO, it's going to become a non-qual. But the non-quals, when you exercise them, potentially there's going to be a tax that's due if there's a difference between the fair market value of the stock and your exercise price. That's the main difference. Tax treatment, it's important who can get them. Still, you need to make sure that you can issue them under the securities laws and under the plan, but that's the difference. Now, let me take a step back and also give you another piece of information. Today, we've been focused on founders and early stage employees. By and large, they're issued shares of stock via restricted stock purchase agreement. That is, they pay for those shares at some nominal value because the company is worth pretty little because it's just starting off, and they're subject to vesting. As you move forward in time a little bit, the company is hopefully getting some value. Maybe not those first couple of employees, but at some point, you're going to want to issue them options instead of stock because it's just easier. People are expecting it. They don't have to come up with the cash to pay for the stock right away. Before you do, so that you know what the right share price is the exercise price for each share of stock, you need to do a 409A valuation. Now, that used to be pretty expensive to do, but it's come down a lot in price. Carta and other services do that. But that's critical before you start issuing options, whether they're ISOs or non-quals. As a founder, how do I protect myself from being forced out without much vested stock, perhaps after signing over my IP? Let me just take a drink of water and then I will answer that. So I get this question a lot. And there's not a single answer for it. Sort of the best analogy that I've come to date is that a corporation is sort of more like a republic than a straight up democracy. I say that because it's the stockholders who elect a certain number of directors. So, the answer to this question is really going to sort of depend on what your corporate setup is. How many stockholders do you have? How many directors are going to be issued? Who's on your cap table and voting that? What kind of voting agreements you may have in place in terms of, even though someone may have a right, or even though you may have rights for each of your shares, rights to vote based on each of your shares, you may have a contractual commitment to vote one way or another, depending upon what, somebody or a group of other people want you to do. And I'm going to say that because, when you do a preferred stock financing and you raise venture capital, there's going to be a voting agreement. And, for certain things, the investors are going to want to make sure that they've got a seat on the board. So they will say, a lead investor or maybe a majority of the investors, the holders of a majority of the shares of that particular round, like that A round, will require that everybody vote their shares in favor of whoever their nominee is. So that's some background, kind of high level. To make it more concrete, I think the best thing you can do on the outset is think about your capital, the plan of raising capital, hopefully for the life cycle of the company, but understanding that you're really not going to get full resolution of that. And being aware that as you move through time, your ownership percentage is going to go, the founders are going to go from having 100% of the company to 70% of the company to, 50% of the company to 40% of the company. And just understanding that, one, that's part of the natural progress. And then two, for each of those rounds, thinking about how critical it is for you to, when you're giving up that control, under what circumstances. Because it's usually not a switch. It's not a binary switch where, okay, I control this thing, now I don't control that thing. What happens is there are certain negative rights and covenants. And again, they start to sort of creep in, and that's part of the natural process. If you want that money, the investors want to make sure that they've got some ability to supervise or to get insight into their investment and potentially to supervise or affect the direction that the business is heading. So the best thing you could do is model out your raises to sort of see how your overall stake is going to drop, and then be mindful as you're doing each of those rounds, how your particular stake, you know, whether or not you individually would be able to block something or get something done, or what coalition you will need to build in order to, you know, effect some outcome or effect or maintain the status quo, if you will. Michael, I hope that answered your question. But you know, in some, unless if you're previously very successful entrepreneur, or you really are just knocking it out of the park and you've got just a tremendous amount of desire from the venture community to invest in your company, the model by and large, you know, over time reduces your stake and reduces your control. Okay, well, it looks kind of like I've answered everybody's questions. Let's see if we've got any other questions or comments. Is it okay to issue advisor equity without equity? I'm not sure I understand that question. I apologize.
Well, actually now people are not muted, so whoever raised that question in the chat room can actually speak up.
Oh, super. Won't
I
just be
think it's yeah, it's a person with the initial PAL. Would you speak up? The person who raised the question. PALS. Okay.
Can folks on an H-1B visa start a C Corp? I apologize. I'm gonna punt on that issue because I'm just not steeped in the immigration law area. I feel like that issue has come up before and I just don't remember. We always bring in an immigration attorney to help with that. Oh, is it okay to issue advisor equity at the time of incorporation? Okie dokie. Yeah, I mean, at or around the time of incorporation, absolutely. You know, we see that happening from time to time if you've got an advisor and the company just kind of hasn't gotten started yet. So yeah, now usually that form of equity is in restricted stock as opposed to doing an option, because as I said, to do an option, you're gonna need to get a 409A valuation in place. That usually costs at least a couple grand. And you know, super early stage is not a great use of your dollars to do that. Oh, is it okay to issue advisor equity without vesting? Well, it sort of depends. I mean, usually what you want is vesting so that whoever is receiving the stock is going to stay motivated and engaged over some period of time. If the amount of equity you are going to issue to them is such that, you know, if they received all of it, it's not a problem, then it's probably not the end of the world. And you know, again, it's all in matters of degree, right? I mean, if you're going to issue them 5 shares, which is 0.00, I'm making up a number, but 0.00001 of the company, no one's going to probably care about that. If you're going to issue them, you know, 2.5 million shares, and that's 25% of the company, it's a different issue. So it's all about context. Usually the reason why you have them vest is so you keep them engaged and motivated, and you can terminate their advisor relationship if they're not performing. And you keep them engaged, just to sort of, you gave me a little bit more information, keep them engaged in terms of giving you their expertise. even though they're not necessarily doing sort of work or development, but just getting input from them. You want them to take your calls over time. Okay.
So, okay, I think we're coming to our now 1:30. So do you have one more slide with your contact information, Jason, you want to share?
We'll take it back up to the top because my slide information's at the top. And then Joseph, if it's okay with you, I want to just correct one typo. So I'll resend you the slides before you send it out to everybody. But I want to thank you, Joseph, for inviting me today. I want to thank each of the attendees. Also, of course, IEEE. My name is Jason Putnam Gordon. I'm a venture capital and emerging growth company attorney with Polsinelli. Email is jgordon@polsinelli.com. If you've got some questions, happy to set up. I keep office hours sort of Friday afternoons Pacific time, and happy to set folks up in a slot and just have a general conversation with them and answer whatever questions you have.
Okay. I forgot to introduce myself when I first started. My name is Joseph Wei. I'm the chair of the Startup SIG for the IEEE organization in the Santa Clara Valley, which we have over 11,000 members. And feel free to send me email, joseph.wei@ieee.org, and I will provide you with the links to our Startup SIG website, and then we can also keep you posted on future events. So thanks everyone, and a virtual applause for Jason for his great content and presentation. So everyone have a great rest of the afternoon. Thank you very much for joining.
Thank you. Goodbye.